Welcome back to another episode of What's Your One More. In this episode, what I want to talk about is another data set confirms what we've been saying. No bubble, just increases. I'm going to jump right into it. So one of the things that we use to measure home price increases are two major indexes, right? You got the Case-Shiller index, which we've talked about for years. It's considered the gold standard for appreciation. And this index measures every transaction type beyond single-family residence as well. And it measures all property types. But what it measures is the month-over-month increase as well as an annual increase of property appreciation. Now, inside of this is every type of transaction type, including cash. So, the old adage, cash is king. You probably have a little bit more leverage in this index, meaning that if you went to go buy a property and you're saying, hey, listen, I want to buy this home, you offer a full cash offer, maybe a slight discount, the seller may be a little bit more intrigued to take that. So this Case-Shiller kind of incorporates that in there. Now, what I look at on this is we got April's reading, right? Everything's in arrears. So when it comes out in the month of June, you're getting April's readings for that month. But inside of this particular reading, we had another monthly increase. And when you take the monthly increase, which rose to 0.3 on the month, you have an annualized increase of 6.3 year over year. That means 6.3% appreciation year over year. Now, that is the whole United States being evaluated there. And what's interesting to me is that kind of negates a lot of the opinionated stuff online that things are going backwards, this crash is happening. There's also this notion that just because we have more inventory coming to the market. And again, in some markets, it's coming at a more rapid rate than other parts of the United States. And in some parts of the United States, it's coming at a more slower rate than the rest of the United States. But there is inventory coming to the market. But, one of the things I think gets lost in this is that there's this notion that because inventory is coming to the market, that's a bad thing. That's not a bad thing. That's actually what we need in the market. We need more inventory, something we've been saying a long time ago. But in some of these things that I read online and some of the perspective online is that, oh my gosh, more inventory to the market, this is part of the doom and gloom. And that's not correct. That's not really accurate at all. What we're looking for is a healthy amount of inventory. We've been so unhealthy for so long that we need more to come in. And so this additional inventory that's coming on, which mind you, at the tune of, right now we're just around 4 million homes in total. Like that's still below where we want to be. That 4.1 seems to be the number. But, when you look at the weekly amount of homes that are coming on, it's still not enough. And so with that, we're still almost below this level of comfort inventory. And when you look at these indexes, they're kind of showing you that because there's no reason in this market that with rates elevated at the level they've been at and home buyers, kind of at this brink of affordability, that home prices should be going up. And yet they are. And so these indexes are reciprocating what we're seeing out there and showing that. So this was just another strong report confirming that home buying is still a very good investment option. And I know many people online disagree with me. If you go to our YouTube channel at What's Your One More with the number one, we have very healthy debates on there, discussion points about this. And, and we even read off some of the commentary on here. And again, I can't thank you guys enough for the participation on there. That's fantastic and it's healthy and you guys bring some great points. And kudos to some of our subscribers. You guys are bringing some healthy information that I'm like, oh, you know what? Thank you for doing that. But there's another index, right? We look at multiple data points. There's another one. And sometimes if the data points are conflicting, you can step back and go, kind of like in the job report, like, well, who's right, who's wrong, and who's accounting for the right stuff, who's manipulating the data. But when both data points are pointing to the same thing, it makes you go, well, okay, that in line, there's something going on there in the right way. We have a confirmation is what I would like to say. So the second index that we would look at, the second data set we would look at is something from the FHFA, the Federal Housing Finance Agency. Now, this agency represents Fannie Mae and Freddie Mac. So when we get a data set from them, what we're going to get is something that reflects what we would call conventional loans, right? And for those listening, you know exactly what that is. This is not going to be jumbo loans. This is not going to be FHA or VA or USDA loans or any type of commercial loans. This is just strictly conventional lending. Now, I think it goes without saying that's the bulk of the market right now. That's the bulk traditionally of the market. So that's why this index carries weight. The other reason is this index represents all the financed properties that are conventional. It also gives you an indication of what that agency is going to do to maybe raise the loan limit. And over the course of the last 5 years, we've seen that loan limit go up substantially because of what this index is representing. So it does get a lot of attention, and it's something that we, as as forecasters, look at. It's not the gold standard like Case-Shiller because it encumbers the whole picture, but this is something that encumbers what's going on the financing side. And the reason I say that is because now you could probably, raise the notion, as the data suggests, people that are financing the loan may be willing to pay a higher price than people that are paying cash. Because again, those cash offers, cash is king, have a level of negotiation that a financing offer may not have. So we typically see this as a little higher and a little more than the Case-Shiller, and sometimes they're in line. As in this case, they're exactly in line as far as year-over-year appreciation. Now, the home price index rose for the month of April as to 0.2, right? But the year-over-year is 6.3. And again, that's exactly in line with the Case-Shiller. It has been running a little bit higher, but they've actually kind of paced themselves out at the same point. But again, that's another confirmation of the market. And I keep going back to this idea that more inventory is coming on the market, again, below the healthy amount. And, for our new listeners, there's this notion for years that a balanced market would represent something on the lines of like 6 months worth of inventory. And that's kind of a tricky metric, because what that's saying is that if every home in the market that you had currently active sold, that you would run out of homes in 6 months. Now, we know that's a theological number because it doesn't actually represent the market. Like, for example, you can't run out of undesirable homes. Probably some of those homes have been sitting there for quite some time. But there's the theology that you would run out of this, right? And so right now, we're nowhere near that number in the United States. That's that imbalance. So now the argument is, well, maybe it's more like 4 months, right? Because we've had more population come on. We've had more immigration in the United States. There's more homeowners than there's ever been before, but we haven't built enough homes to offset that demand. So maybe the real new number is like 4 months worth of inventory, because you're probably not going to get to 6 anytime in the next decade. It just probably isn't going to happen as far as creating new single family residence homes for people to live in. So maybe that new confirmation is 4, but nonetheless, we're not there. And the inventory coming online is just helping us just a little bit. It's not even putting a dent into it. So creating more options should, in theory, provide more transactions. But I'll go to this statement. The only thing that is going to loosen up these price points, right? And I think this is important because, online, people have an opinion about bubble, burst, collapse. This is not 2008. We've done numerous podcasts as to why this isn't 2008. But I think you could very well make an argument that price points might become less sticky and loosen up a little bit towards the buyer's behalf. And the reason I would say that is that, right now there's this, like we talked about, there's lock-in effect where the seller just doesn't have to sell so they can kind of name their price. The only way that's going to kind of start to slide more towards an equilibrium is if rates come down. You need rates to come down, or you need a tremendous amount of inventory to enter the market. We know that tremendous amount of inventory is not going to happen because of the lock-in effect, and we're not seeing it happen, and we haven't seen it happen. And it's going to take the loosening of rates for buyers to have a bigger appetite and have the ability for affordability, as well as some of those sellers that are locked in to open up that inventory that's locked up right now and provide that. Those two things happen, you'll start to see some loosening up of the home prices, but that won't last long. And, that's this counter to the argument. It may loosen up a little bit. It's not going to last a long time. There may last 60 days. It may last 120 days. But I think that that's the extent of what that loosening period is going to be, because it's going to go right back up into a ramp up again, because it doesn't take long for the market, no matter where you are, sub-market, it doesn't matter. The market will absorb the affordability, and usually the seller absorbs the affordability rather quickly. The minute there is any type of anticipation that there's more affordability available to the market, boom, the seller will absorb it in any price point at any product. It happens all the time. In this particular case, we're talking about real estate. So I think all attention turns towards Friday, right? You're listening to this on Monday, so the PCE is already out. We're probably in the studio on next Monday recording some information on the PC. But hey, I would like to give you a forecast, right? And again, I'm forecasting this. It's Wednesday the 26th, right? But there's some things here that kind of give us some indication that the PCE reading should come in lower than what it's currently at. And that's a win, right? That's a win because that's what the Federal Reserve is using as their form of, hey, listen, inflation, are we winning the battle on the inflation front? Currently, we're at a 2.8 on the core. Their target rate is 2%. So we've got a little bit to go, right? And you have to understand when you hear those numbers, while they don't seem, that far and from each other, 2 to 2.8, it would take a significant amount of time to get from 2.8 down to 2 at the readings in which we're getting, right? So there is this anticipation that the core PCE could come in at around 2.566, right? And they always round up, so that puts them at 2.6. If it was 2.54, then it would round down to 2.5. There's a chance for that to happen. There's a greater chance for it to be at 2.6. But as it comes in at that number, that is still a win for the market. And it gives more confirmation that that cut is coming in July, potentially July, more than likely September, as we were told by one of the Federal Reserve members when we got a chance to sit at a fireside chat with them. But I think what's interesting here is no matter what happens on this, and again, it's Wednesday the 26th, you're listening to this on the 1st, it'll be interesting to see from when we record this to the 1st how the markets react to this, right? Are they building it in? Is it anticipated? Are we going to see that drop? And then once they see that drop, are they going to say, oh, a rate cut is coming, the rally is coming? I think no matter what, the needle mover, we continue to harp on this. I think this report used to be the mecca of what the Federal Reserve was looking at, as well as investors, as well as the bond market. I do believe all attention has turned towards the job market. And Daniel and I continue to talk about this on our segment, that it's going to be jobs. It's going to be, is the job market, is the unemployment number starting to run off a cliff like we talked about in one of our episodes? Because if it does, it's hard to pull it back in. We're currently at 4.0 unemployment. If we get to 4.1, that's going to be a problem. We get to 4.2, big problem, right? Starting to run away from them. And a lot of the Federal Reserve right now is giving mixed signals. Now, I think this is part of their yield control, part of their market control, not wanting to show their hand. But you've got multiple members now that are significantly worried about unemployment, and you got other ones that are saying, hey, listen, our focus is still on inflation, and we're going to do what we got to do to get to 2%. And that's kind of their standard quo with the media and the general public. But as Daniel and I discovered in one of our meetings, as I talked about at that fireside chat, things that we heard that doesn't necessarily make it to the media was, yes, that's our stance. We are firm on 2%. Followed up with, the only way we will pivot is if these job numbers start to make a turn that we're uncomfortable with, and then we will take the necessary measures. So it's in the bag. We understand that. In the bag meaning they know that unemployment number is very important and the job numbers are important. And I think really behind the scenes, that's what's driving the latest rate cut and when that is going to happen. So that's what we're going to be focusing on. The PCE will just be further confirmation that the actual inflation is dropping, and that's important. But as I wrap up this podcast, and I know it's a rather short one here, as I'm heading to go out of town here for the next couple of days, one of the things I'm trying to get one in here to stay on track. One of the things I want to talk about was this. I heard this term the other day. I thought it was hilarious. I keep talking about this propaganda online, but I heard this term, and Charlie, don't try to laugh over there when we talk about this, but all this negative stuff we're seeing online, doom porn. I thought that was hilarious. Doom porn is what they're referring to it as. And so the reality with that is that, hey, listen, be aware that a lot of the people that are putting this stuff out there, this propaganda, is that the reality is this. They're not, this isn't their profession, right? They don't follow this stuff. They don't have data sets. They aren't reading things. They are throwing their opinion out there, and their goal is to get you to listen to what they're saying to drive up their views. But the reality is this is not educational from a standpoint of, it's not benefiting people. It's not benefiting the audience. And, if you listen to our last episode where I had Nick the intern on here, I thought it was hilarious because he's been spending some time with us, and we've really been hammering out all of the positive stuff about real estate, as well as the potential risk, but where we are as an overall market. And he was telling me that he was riding with someone down to Tampa the other day, and his buddy who, is looking to buy a home literally said what a lot of people his age group say, well, I want to buy, but it's just too expensive, or I think home prices are going to come down. And he shared with him some quick hits from one of our episodes, and within seconds, he was like, man, you're right. And one of the quick hits was the guy says, I feel like I'm buying at the peak. And, as we showed in one of our episodes, over the last 4 years, you're always buying at the peak, right? I mean, do you think the people that bought in 21 felt they weren't buying at the peak? And then you look at what happened in 22, they're pretty damn happy. You look at where it is in 23, they're real happy. So the reality is you're always buying at a peak. It's always a new peak being established here. And that's interesting because, it only took him a minute to kind of curtail the opinion, and the person go, oh, you're right. He hit him with data points, facts. And that brings me to my point that, one of my dear friends told me, he was like, the problem we have right now with our society and people looking to buy homes is they want to treat homes like stocks. And I agree with that. We've talked about it. But they're using fear over facts to make their decision when they should be using facts over fear. I love that concept. I thought that was a home run. And that's what a lot of this propaganda online is doing, because there's no barrier to entry. Like, you don't have to have like any credentials to do that. Anyone can go make a podcast, including me. I'm sharing experiences. I'm using data points on this. We're doing extensive research before we bring this stuff out to you. And by the way, if you want to look at this forecast that we have broken down on here for the PCE, go to our YouTube channel at What's Your One More. Check it out on there. We've got the forecast and what all's going to happen with it and why it's there. Nice little graphic we have on there. But listen, man, there's no barrier to entry to that stuff, that propaganda online. And the other thing is this: it's all opinions. Like, it's all opinions, and it's not factual. And so I just encourage you that if you have someone, you got a friend, you got a family member, you're talking to someone at the dinner table, you're just chatting it up, and they start throwing out some of the fear mongering, hit them with some of the facts we're talking about. And more importantly, share this podcast with them. Say, hey, listen, I've got a person we listen to over there. These guys put in their due diligence. They're doing their work. I like what they're talking about. And at least they're bringing some facts to the table. And their forecast, for the most part, is dead on. So if you like what you're hearing, share this podcast. Please 5-star review it, specifically on Apple or Spotify. We'd love to hear your feedback. And then also on our YouTube channel, if you're more of a visual person, we got all the visual aids, we've got all the charts, and then obviously we've got all the show notes on there as well. And if you're not subscribed, please do, and share some comments with us. We'd love to hear your feedback. Hey, thanks for listening to this episode, and we'll see you back at the next one as we break down the PCE and what it means for the Federal Reserve on Monday at the next episode of What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.